We had some questions sent in advance that probably kicked back for Zoom, but I think that we have a representative of what is going to be important to the group. I'm going to start off with a question about forecasting and lending. Let me let our team over there have a jump ball and any of these questions. The first question is, what upcoming changes do you see in the lending environment as COVID COVID cases drop and economic activity picks up? What do you see happening, guys?
So I think, as COVID cases continue to drop and as we come out of this whole thing, and I think we're pretty much, we're not there yet, but I do think COVID reserves are going to go away. Fannie and Freddie loans here in the third and fourth quarter. I think this first half of 2021, we've seen a lot more non-Fannie and Freddie business, a lot more bridge lending, a lot more bank lending. And I think Fannie and Freddie will be playing catch up here in the second half of 2021. So I think their rates will become more competitive and we'll see a lot more. We'll see Fannie and Freddie come back in a big way in the second half.
Yeah, that's great. Let's hear it from the horse's mouth. Fritz, come on up here just for a second. Well, Fritz is with Fannie Mae's DUS program, so he really has the inside information about what's going on. So I want you to listen from the man himself, the underwriter, doing the Fannie Mae stuff.
I agree with John. In terms of the COVID escrows, I think those will be done in the next quarter or two. Basically, on full leverage deals, are mostly 6 months of interest only or 12 months of interest only, depending on the size. And then in terms of overall volume, Fannie and Freddie did way too much volume in Q1. Each Fannie and Freddie have $70 billion that they can do every year in lending, and I think they both did about $25 billion in Q1. And so they've had to kind of throw on the brakes here, mostly in February, March, a little bit down to April, but we're starting to see lower pricing. So I agree with John, probably midsummer, it's really going to take off.
Fritz, you mentioned, anything on what you think about Freddie and COVID?
They're nearing each other in terms of reserve. So one lender, Fannie will cut to 6 months of interest only, and Freddie needs.
Great, thanks. This is one that I'm really surprised with it asked. What do you forecast the interest rates to be short term and long term? Get rid of that one, Chris. Good job.
Not the smartest guy right here in the room.
No, I mean, I think it's pretty, I think every forecast out there right now is up. And it's just how soon and how fast. And so almost everybody, by the end of the year, everyone's projecting 10-year treasury at 2. And then next year at 2.5. And so the question is just, number one, do the floating rates follow? So Fannie, all the Freddie stuff, all the bridge loans, you don't even really care what 10-year treasury is doing at the time because it's really SOFR, LIBOR base. So if the Fed starts moving those rates, that's where you start jumping up. And so a lot of people are moving floating rates right now. The interest rate caps have come up, and so those are $100,000 pretty much at a minimum. So just watch those. But I think it's still low. I mean, when Paul started the business, it was 15%, right? So
16% on home loans. Primarily, it was at 21%.
And we're screaming about 3.5. So I mean, I think that is the biggest question.
So I actually think fixed rate lending is going to come back in a pretty major way here also in the second half of 2021. The Freddie floater has been kind of the buzzword here the last 12 months or so. And I think 10-year treasury, with all this stimulus coming into the system and the infrastructure bill and all that stuff, I think the 10-year treasury is going to be on the rise. And I think if you're a borrower, if we do have inflation, the best hedge on inflation you can have is to own an income-producing asset like a multifamily property that's financed with a fixed rate. And so I think you'd be wise to move into a fixed rate loan. If you have a floating rate loan on your property right now, and I also think, to James's point earlier, people that finance with the Freddie Mac floater in the last 12 months, just make sure you're watching your LIBOR cap or your SOFR cap, because those have been all-time lows. And as the Fed starts to hike rates again, which, forecasters are saying won't happen until 2023, it's not, SOFR caps are going up today, and they're gonna keep going up and getting more and more expensive. And
So what really does that mean? Because a lot of people who don't, haven't bought the property, they really don't know what a cap is.
Sure, yeah, so, floating rate lenders, so bridge lenders or Freddie Mac, with their floating rate program, those loans are, the interest rate is based on SOFR or LIBOR, which is a short-term rate, so that's a 30-day maturity or a 30-day rate, so your rate will adjust every 30 days. So there's interest rate risk, and so what Freddie and these floating rate lenders do is they require borrowers to buy what's called a LIBOR cap or a SOFR cap. And basically what that is it's an insurance policy that caps how much SOFR or LIBOR can increase. So for instance, if you have a Freddie Mac floating rate loan and your rate is SOFR plus 2.75%, your all-in rate is 10 days, wherever SOFR is, so 5 basis.
1 basis point.
One basis point, yeah, 2.76 all-in is your rate. But if SOFR were to go up to 1%, your rate would increase from 2.76% to 3.76%. And so what Freddie will require, what other floating rate lenders requires is to buy an interest rate cap that basically says you pay a premium up front, and then your SOFR or your LIBOR is capped at 50 basis points or 1% or 1.5%. And so just like property insurance, if there's a high risk for wind and hail, you're going to have a higher insurance premium. There's a higher risk for interest or SOFR or LIBOR increasing because everyone thinks, Jay Powell's going to start hiking in 12 months, then the cost of that insurance goes up. And so I think some people, if they're not watching out for that, could be caught flat-footed, where in 3 years they wake up and realize, oh, we gotta go buy our SOFR cap because our current one's expiring, and the lender wants us to buy another one, and oh no, it's a $300,000 check that I didn't think I'd have to write.
Again, 6 months ago, what was that cost of insurance and what is it today?
Well, what I would say is probably the most interesting stat that I heard on LIBOR, obviously LIBOR caps, this is a LIBOR cap statistic, but one of our LIBOR cap providers, Pensford, back in July of 2020, sent over a chart that showed the cost for a 3-year term with a 1% LIBOR cap strike for a $25 million loan was $25,000 in July of 2020. That same LIBOR cap was $250,000 in July of 2019. So it was 1/10 the cost. It's increased since then. That same cap today is probably $70,000 or $80,000. The benchmark I kind of use is 1/3 of 1% is the cost of that premium. So it's gone up. It's still historically cheap.
So what you have to watch for is this is all going into your underwriting, right? So if you have a fixed rate product and it has yield maintenance, you're going to have a prepaid penalty, right? So that number is just a big number versus the floating rate product, you're buying interest rate caps along the way, and then you have the 1% equity. So you just have to sort of weigh the pros and cons between the two. And if you want to sleep at night and you want to just have a fixed rate, you take the fixed rate, you have the yield maintenance penalty. But if you want to have a shorter term, maybe 3-year, and then do the floating, and then just buy caps along the way.
We've had a lot of activity with bridge loans. And one of the questions that came in is, what's the difference in closing costs between bridge loans and the agency loan?
Sure. So with bridge loans, the closing costs can be quite a bit higher than they are with agency loans. So for bridge loans, probably the biggest thing is your lender legal expense. So any time you do a loan on multifamily property, it's the borrower that pays the lender's legal fee. And bridge loans, because their loan documents are much more custom, much more tailored for each transaction, whereas Fannie and Freddie, they're more or less boilerplate or template type loan documents. The legal fees on bridge loans can be higher. So with Fannie, it might be 12, 15,000. With bridge loans, it's you're probably looking at at least 30,000. Could run higher than that. A lot of times it does run higher than that. So for one, your legal fees probably $30,000 to $40,000. Your third-party quotes are about the same, they're usually around $10,000. You do have to buy a LIBOR cap, so LIBOR cap, we can get you a quote for what that LIBOR cap would cost, but it'll depend on the loan amount, that's another added expense. Anything else I'm leaving out?
No, that's it.
I just ballpark it, bridge is usually about 4% of your loan amount, and then Fannie Freddie 2.5%, 3%.
So the question really comes down to, why do you use a bridge loan versus Fannie Mae loans? So Fannie Mae is a permanent loan for 10 or 12 years, and the bridge loan is for 3 years or 5 years, with 2 one-year extensions and the 3 years. So right now, the reason why people are getting more bridge loans is because they don't have COVID reserves like Fannie Mae is right now. And they can go with some higher leverage in these transactions. And so people who offer bridge loans, it might be more popular, it's non-recourse, it's usually interest only during the period of time. In that, sometimes you can throw in 75% to 100% of the capex into the deal. Any more? And so the opportunity to do a bridge loan sometimes is a better advantage in your toolbox of different ways of structuring the deal.
So like pre-COVID, there was, maybe 5 to 10 bridge lenders, and as soon as COVID hit, those guys disappeared, like got bridges in the night, gone. Nobody could find anybody, March, April, May of last year in terms of bridge lending. The only guys who were at the table were Fannie, Freddie, those guys were at the table post-COVID. And not until really towards the end of last year were really bridge lenders coming back. So there was 1, 2, 3, 10, 15, 20 bridge lenders all of a sudden out. And so all of a sudden your rates on bridge loans in the past were always 100 basis points, 150 basis points higher than Fannie Freddie, but they just kept competing against each other. And then now they were lower or on top of Fannie Freddie. So as 10-year treasury rose up the last year, bridge lenders were coming down. So that's why you've just seen this storm of bridge lenders.
And bridge lenders are not a regulated bank because they're not a bank. So it's like us putting money together to give to you. I think we'll do this one at 80%. How about 85? Okay, we'll do 85. So there's really no rules or regulations. Everything like John was saying is that it's custom to the deal. So bridge lending is a lot more popular right now than Fannie Mae and Freddie Mac for a period of time.
But Fannie and Freddie are not going to sit there long, right, Chris?
No, because they both want to hit 70 billion to get their cap for next year. So I think, I would say in the summer, like I said earlier, I think they'll find ways to be more creative. Because part of the challenge right now too is just underwriting some of these deals on a permanent loan basis. When you need to hit a 1.25 times coverage on some of these deals, you just can't get, you're not sizing to 75, 80% leverage like were a year or two ago. It's really challenging. I would say most times maybe 70% is kind of baseline in a major, I would say. Where a bridge lender is able to, look at your pro forma rents and look at things differently to get to the higher leverage costs.
It seems like as our cities are expanding, and people are moving farther and farther out as they can, what's different in financing in secondary markets?
Definitely easier. No, I'm just kidding. Secondary markets, I would say, as people have gotten sort of priced out of the primary markets, they've gone to secondary markets really searching for yield as investors. But then lenders, Fannie and Freddie, have gone out there, but they might have a higher debt service coverage, so a little bit lower leverage. And then bridge lenders have, at first, they didn't really want to go out there. When I was a bridge lender, when John was a bridge lender, you only have 10 guys in your shop, and you might not go out to clean, right? So, just depending on where the deal is, it's gonna depend on, you're gonna stick mostly to primary markets, but as more and more bridge lenders lose deals in DFW, all of a sudden Colleen looks great. So right now, the bridge lending in secondary markets is still strong, but it's just not as many participants as the DFW.
And one thing I will is listen to the guys that are going to be with Michael Becker tonight. Paul Yesbeck, who handles a lot of transactions in San Antonio, in Killeen, Parker Heights, Waco, that whole area. Listen to what he's saying about what's going down in transactions. Listen to John McGregor tonight, and I want you to ask him questions about what's going on in Abilene or in Amarillo or up in New Mexico. Listen to what's going on in those markets. Maybe you can start to position yourself outside of DFW and listen to what they're saying.
What loan options are available for development projects, construction projects?
Sure. Yeah, so for development projects, I actually was having this conversation later tonight with Lane B, who is doing a project in Manor, Texas, which is
Small project. Small
Yeah.
project. This is.
just a $50 million project. It's just a small one.
60.
Actually, the one that Fritz worked on, Colliers did the HUD loan on that. And as I've been having conversations with some developers, I've been talking about doing, so I guess just to back up, to answer the question, what's available for construction lending for development projects? You know, as it relates to multifamily, there's HUD. So HUD has their 221D4 program. And so on that, they can go up to 85% loan cost. Very low rate, you know, down in the low to mid threes right now. Somewhere in that range, and 40-year term, 40-year amortization. But the drawback with HUD is that it's a 12-month long closing process. So it takes a long time to underwrite those loans, close those loans, and ultimately start the project. So there's HUD, and the most common source of financing for ground up developments is bank financing. And, you know, banks are typically 65 to 75% loan to cost. I've been hearing that banks have started to pull back a little bit on financing development just because material costs have gotten so high. I think lumber is, you know, about 4 times the cost of where it's been historically right now. So it's harder to make development projects pencil. And then, you know, outside of that, there's non-recourse construction lenders out there too. And, you know, if it's non-recourse, you know, the bank is going to be a personal guarantee. It's going to be a full recourse loan. And if you're doing a project like that, or if you're really doing any project, it's important that you have a really strong general contractor who has a lot of experience, can write a guaranteed max project, meaning that they can guarantee that the total cost of the project, so if there are cost overruns, they can absorb those costs. So there's a lot of different options out there for construction financing.
Thank you. And one last question before we offer any questions from all of you. This one is specifically to Ryan. Ryan, how do I get better long-term loan terms and long-term deal besides watching James hang on YouTube?
Listen to the Old Capital podcast. Everyone. No, but seriously, work with us Old Capitalist mortgage brokers. We help sell you and the deal to the lenders. In my experience, besides leverage or better debt cover, would be you having a long track record in keeping the property well maintained and paying your debt service on time. Makes you look less risky to a lender. So, okay, anything else?
I mean, I think it's just being prepared, like when you take in a package. I think with Fannie and Freddie, they're really looking at the property, probably 80% on the property and 20% on you. But if you're going for these bridge loans or construction loans or things like that, I mean, it's half and half or even more specific to the borrower. That is their very first question. So a lot of times when people are asking us for quotes on bridge loans, we're having to ask for their experience, their background before giving it, because you just have this shorter time frame to execute your plan. And so there's a lot more pressure on that plan and on that loan if you have an issue 2 to 3 years.
And watch you on YouTube.
There you go. Thanks a lot.
Any questions from any of you to this group? We've got up here for a few minutes. We should be glad to answer anything, or there'll be time later. And we mentioned that we've got some space available reserved over at the Brick House, which is on the access road at 114. So afterwards, if you'd like to stop by and talk to me, we have.
What are some pitfalls of the bridge loans? Could you give us some pitfalls of the bridge loans or things to look out for besides the cost?
Sure. Yeah, that's a great question. So what I would say about bridge loans is, they're a double-edged sword. The positive is it's higher leverage, so more loan proceeds, lower rates. The other side of it is these are short-term loans. So these are a 3-year term, and the clock is ticking as soon as you close on it. So it's really important to get in, execute on your plan, put in the CapEx, install those water conservation toilets that the potty princess over here is pushing, and make sure you can improve the NOI, because you only have 36 months, and 36 months can go by pretty quick, and you do have extension options. But if you're not able to execute, you don't increase the NOI, or worse, if the NOI falls for some reason, then the value could be lowered, and you could be in a spot where your loan's maturing, and you have to either sell or do a cash in refi instead of a cash out refi. So that's probably the biggest negative, I'd say, just the short-term nature of them.
Any others? All right. Thank you all. Michael.
So before Michael comes up, we're gonna have our friend, Crystal Lee, talk a little bit about what's going on with the Sumrock group. So, we have Crystal Lee to speak for a few moments.
All right, buckle your seatbelts. We've got about a 30-minute presentation here, so I'm just kidding. Oh, hi, I see so many familiar faces. It's so good to see everybody. There are just, I mean, I'm looking around this room and my heart is just so happy right now. It's great to be out and to be in public and to just be networking and seeing each other. A couple of things that I just wanted to share with you. So I'm Crystal Lee Thomas, and I work with Brad Sumrock. And oh, hi. It's great to see all of you. So a couple of things that I've been just listening to this, and what I've been hearing is it is a very interesting time in financing right now. And a couple of things that Ryan specifically said was you want to be prepared and you want to present yourself as a low risk to lenders, because you are probably going to need to be a little bit creative. A lot of you have done many deals in multifamily, so you do have a track record, but maybe you've never done bridge loans. So, you definitely have to leverage a team like Old Capital to help you understand how to do all of that. And that's exactly what we do with Brad Sumrock, is we have a team of people to help us. So we are actually doing an event. I don't know if you have that slide, James, if you're able to pop that up there. If not, no big deal. But we are doing our 4th annual Apartment Investor Mastery National Conference. And it is going to be July 16th, 17th, and 18th. And we are bringing in a powerhouse of speakers. I wish I could tell you who our keynote speaker is going to be. The ink is not dry yet on the contract. Let me just tell you that when we are going to announce this person, we will sell out. And we are targeting over 1,000 people in person. So come to our event, AMACCon, July 16th, 17th, and 18th. One of the biggest reasons why it's very important to come is because we're bringing in relevant industry leaders, industry speakers, and as you heard tonight, there's so many things changing. You want to be prepared. You want to ensure that you're surrounding yourself with the right team, the right people. So we definitely are bringing in Grant Cardone. He's one of our keynote speakers. We've got some other speakers that we're bringing in as well. The one that I wish I could announce, but I can't yet. So this person is a household name. This person is on a very popular TV show that entrepreneurs love. And this is going to just make this event blast off. So we actually just restructured some of our ticketing options, and we haven't even rolled it out. So you guys actually get to first look at that, we're giving you some discounts. If you go to aimnatcon.com, and that's AIMNATCON, that stands for Apartment Investor Mastery National Conference. aimnatcon.com, and you can get your tickets. We have virtual options, we have 2 in-person options. I'm just telling you guys, like, this is going to be one of the best national conferences we've ever done. It's July 16th, 17th, and 18th. And I also want to give a quick shout out to, because I see Jeff King over there and Aaron Kelso, hello. And I see Kelly Simpson, Potty Prince, hello. They'll be there. Old Capital will be here. We have a long-standing partnership with you guys. I mean, I was trying to think of the first time I met you guys, probably 6, 7 years ago. And we've transacted hundreds and hundreds and hundreds of loans with you guys. So you guys will be there. Thank you very much. Grab your tickets, please. And if you guys have any questions at all about what we do, you can come see me. There's a lot of Sunrock students in here. I want to also just point out Leander Lima, he's sitting over there. He's also on our Sunrock staff team. I heard that we were all over the internet because we just took a private jet. So I don't know if you saw pictures of him too. I'm not a big social media person, but thank you very much. Talk to y'all soon.
With Sunrock, but, she's had a success this last month or so. So her and her business partner, Larry, sold a property up in Wichita Falls. And Larry, where are you?
Right over there.
Hello, Larry and Troy. So they just sold the property. Again, past performance is no indication of future returns.
Right.
But tell us, Crystal Lee, you sold the deal very quickly.
Yeah.
How did you do it?
Well, we were supposed to close right at the beginning of June. We bought the property 3 years ago for 5.35 million, and we are selling it for 8.45. So not too bad. We're very excited about that. And you know what? I forgot to tell about, kind of my history. So we are syndicators in other deals too. And I also on the way here, I literally at a stoplight looked down because I was like, did I forget to change out my sweatpants? Because I'm like, is this person's play? I'm like, what is going on? We went from 0 to 100. So I'm glad that I'm not wearing sweatpants.
I am too. Thank you, Crystal Lee. I appreciate that. So again, talk to Crystal Lee with networking, talk with her a little bit. Our friend is coming up here too, Mr. Michael Spots. Michael is with Lifestyles Unlimited, another group that we very much support. We got for being multi-family. With Michael Spots.
Thanks, Paul. Again, my name is Mike Spots. I'm with Lifestyles Unlimited. We are a teaching and mentoring organization. We are celebrating our 30th year this year. We have about 26,000 members across the country. And really what it is we help you start to finish. I'm a mentor with the organization, and we teach you, train you, evaluate these assets, and really hold your hand throughout the process. In addition to that, if you're looking to buy, if you're looking to syndicate, we help you syndicate or be IROs, or a lot of our investors are just passive investors. So we can take you through the whole thing. We have offices across the country, and we just continue to expand.
All right, Michael Spots. Mike Spots, make sure you say hello to him. Have a cocktail. So thank you. And then again, before you say goodbye, how many units do you own? Like, because I don't like people who just tell me about how they play baseball. I want to have the people actually been playing baseball. How many units do you own?
So currently about 3,500 that I'm invested in. I own and manage over 500.
There you go. Thank you. The guy you've been waiting for. Now you can open up your eyes, you can pay attention. Here's Han Solo himself, Mr. Michael Becker.
How's it been? All right, we'll have Steve panel with me tonight. To my left, we have Jacob Anderson with Newmark, with Joey Chiminello with IPA, Paul Yath at the Multifamily Group, and John McGregor with Works and Mill Shop. So I got a bunch of guys up here that do a lot of this. business, and so thought maybe just kind of real briefly just go down the line, maybe talk a little bit about yourself for a minute, what you do, your shop, and your specialties. Jacob, kick it off.
Absolutely. Jacob Anderson and my group is called Newmark. We are focused on Dallas Fort Worth. We have a couple of guys that runs in the secondary market too, but mainly our group is in the North Texas region. We have 2 other offices in Texas, down in Houston and down in Austin, San Antonio. Typically, year for us statewide is probably 6 to 8 billion. So that's our group.
My name is Joey Tubinello. As Michael mentioned, one of the 4 partners at IPA. So we're a segment of Marks and Millichap. I get that question a lot. Not a beer company. And so myself, 3 other partners run our Dallas Fort Worth focus, and we focus on Class A and multifamily investment sales. We're a little different than a lot of the other brokerage groups. We have one central office in Dallas that supports the balance of the state and all major markets and secondary. So if you all are looking to explore the new markets, that's an opportunity to provide here locally and beyond. Thanks. Paul Yazbek with the multifamily group. John Krebs, my partner, and I, we formed the company in 2018. We've grown to 15 brokers, and we focus on DFW, San Antonio, Houston, Central Texas, like Killeen. More recently, we've grown into Little Rock, Albuquerque, kind of client-centric as we move into different markets. As clients are looking for yield, we've grown to Louisiana, anywhere where we can find C-class, B-class opportunities for our clients.
Hey there, John McGregor with Marcus and Millichap. I'm on the Llewellyn River team. We have 2 distinct groups. There's 4 of us that do DFW specific deals. For my part, I'm leading part of a group of some of the best secondary market people in the industry. We cover all of the secondary markets of Texas and surrounding states. So we'll get into New Mexico, Oklahoma, Arkansas, and Louisiana.
So I thought we could maybe talk about 2 different topics here, kind of 2 different segments. One kind of a lot of people here are new or aspiring to get into the business, want to grow, get the first deal done, or grow into a larger deal. So we talk some actionable tactical tips on how to get you guys' attention, stand up in the crowd, and then kind of talk about the state of the market. So maybe kind of starting with the first part of it. Jacob, if I'm new in this business, what are some of the things I can do to get your attention? It's a crowded environment right now. The market's extremely hot. Lots of bids. I know Joey has a portfolio out right now, and just about everyone in the entire country, I think, looking at it right now and bidding on it. And so it's a very competitive environment. How do I get your attention out of the gate?
Well, I think it's important to understand who you are yourself, and if you're going for a portfolio you just mentioned, and you have a lot of deals before, that might be pretty steep to start out with. So I think that self-definition is extremely important, and then going from there, I would have these open conversations. I'll put it on my calendar, talk to brokers that's got deals in the market on a very consistent basis, and have those open conversations. What can I do better? How should I position myself? If you mind looking at my ROI before you send it to the seller, so we can kind of optimize the terms. If you see something you don't like that's not the market, please let me know. So I think it's really about being relative to where you are with the units, so you don't overstretch. Even though we have seen a lot of people really stepping up here lately. Year, 2 years. But be relative if you're looking at a 5,000 unit portfolio, you don't really think that might be a stretch. And then ask questions and stay with it. That's probably the most important part. Just stay after it. You will lose more deals than you will win, and that's just
Joey, maybe add on that to that theme. You've seen lots of groups out there that come at you, deal after deal after deal after deal, and eventually kind of the bridesmaids and out there eventually come the bride and get married. I don't know if you have anything more to kind of add to that theme, people that you've seen be
Yeah, I think Jacob said it well. I mean, one of the biggest things I was thinking about as Jacob's giving his answer is any one of us get on average, no joke, 300 to 500 emails a day about any given listing. And so when people pepper us about what's pricing, very generic kind of one-on-one questions, I just implore any of you all who are newer into the space, one of the biggest things I always look at is just passion and body language. And if you're doing over the 4 to 5 week marketing campaign, if you're doing all the right things of going to tour the asset early, asking good, thorough questions, you don't always necessarily need to look at the boilers on your first tour. There are just little things that, and I'm not an expert in any of those things, right? But I just learned over the years of doing this, of just simplicity is always the best. But showing body language from start to finish that you're passionate, you have the equity raised, you have your debt lined up, you bring Paul James and the old capital team to the tour, and you have a team that you've assembled. I think that's where a lot of the people in the crowd that we've been successful doing business with have just shown that from start to finish.
John, you mentioned you do a lot of stuff in secondary markets as well as Paul does. Is there something different that someone can do to stand apart? Because it seems to be a little bit less competitive when you go into New Mexico than say Dallas Fort Worth. Is it imperative when I'm looking to bid on a deal to go out and work with you in person, even if it is an airplane right away or a very low car right away? Maybe some thoughts around that. Which is the one go out and work with you if it's not their backyard?
I mean, that's a good question, right? It's sometimes 2 plane flights to get to a lot of our listings. But first, let me add on to Jacob and Joey's, read the OM. Please, read the OM. No, I'm not joking. Really, read the OM, because we all have a limited amount of time. So read the OM. It's going to tell you a really good story, whether or not this deal might be a fit for you. Don't get us on the phone or drop us an email and say, oh, I didn't know it was a flat roof deal. It's in the OM. Then we can spend our time more effectively. We can coach you to talk about the deal, the points that are most important to you, and help you better position yourself to understand what's at hand here. It's an opportunity that you guys are going to fit. When it comes to traveling in secondary markets, they are more competitive deals than they were 3 or 4 years ago for sure. Working around tours is still a big differentiator. When people take the time to come out and tour an asset that is far away, it really speaks to their commitment to the deal. And we will lean on us as brokers, all of us, lean on brokers and have us tell you the story so you understand what that is. We'll be very clear with you. We don't want you to book a plane flight or two to get out there and say, oh my gosh, you guys were just making up stories. This thing is not like you mentioned. Trust us, and we're not trying to waste your time either. But tours are still very important. We get a lot of people asking us, hey, can we just tour if we make it the best and final? Yeah, that's right. Yes, of course you can. But what if 5 people are best and final and 4 of them have toured? Right? So touring is a big part of it. It's certainly something I strongly recommend it any way you can. We'll try to be efficient with it. Try to work with the schedule, give you plenty of time to coordinate it, time to get out to the site. It's a big deal. It helps.
And Paul, so 2 questions for you. So besides not reading over, like John mentioned, not knowing the basic facts of the deal that they call you, is there anything else you can think of that kind of gets on your shit list and things that potential buyers do to annoy you, maybe unintentionally that they shouldn't do, that you maybe get some tips that do not do list, I guess?
I think John hit on the head with the read the OM. That was probably the #1 thing. And again, almost everyone's deals is market pricing, so you have to ask the price. That's okay. But during COVID, you couldn't tour. We did some Zoom tours. We also had a deal where I toured it. My guy felt like I couldn't, but it was on FaceTime with him. He closed it without seeing the asset. I don't think he's still seeing it today. A hotel conversion in Albuquerque we did. The buyer couldn't tour, or he was trying to be fast, so we had his property manager tour. And that was good enough. They did a FaceTime. And he put up 50K hard day 1. So that alleviated a lot of issues with brokers. The sellers would have is a hard to lose money. And maybe that was less prevalent during COVID, but that seems to be back more than ever. We just did a call for Robertson Clean that James helped us with, and they put up 150 hard day 1. And then we mobile buyers that would make 6 figures up. So that's really come back even in tertiary markets. The biggest thing I think is not being known, like John said, and then on the tours, it's showing passion, showing you want the deal. You okay to tell people you want the deal. A lot of times
they don't do that. I think also when we were working with so many markets, with so many different off-market deals all the time, we can be more targeted in what you're looking for. The price point, the units, things you will not buy. So the more targeted you can say is that I just want to buy a good deal, or you're more vague. We're working in a couple states. We have deals from 50 units to 500 units. So just the more targeted you can be, where you can compete the best, where you can move the fastest, those are the deals we want to show you.
And as, you know, I kind of love the business, I know a lot of you guys at the same time, business at similar times. We all sort of kind of at the lower rung and work our way up. You know, for anyone on the panel, if I'm looking to kind of break into the team at Marcus Village Chat or the team at Mark, I don't want to buy a deal, you know, is it best to go start talking to Brian Bull, senior, or, you know, through Kyle, or do we start a little bit lower on the rung and try to maybe form those relationships? Any sort of tips on how do you really crack in and grow with this business from, you know, establish a relationship with brokers?
You know, one thing we found a nuisance here that was very effective. He closed on a deal and he did a mail merge to us. And I just closed this deal. We didn't know him, and now he's bought like 4 or 5 deals. We mail merged our office saying, here's what I've done, here's the deal. We put up our money day one. That was very effective. He's grown a lot since then. But he really got our attention in doing that. But I would say one thing I've seen some buyers do is they'll hit up every broker in our office. And since we collaborate so much, if you're talking to one broker, he can give you access to all the deals our office has. So if you're having the same conversation with 5 guys and they start talking, and they figure out this guy's talking to everyone, so just pick one broker to work with. If they're not being responsive to you, maybe then you can switch to another broker, but we all collaborate in our office, so it's kind of redundant if you're talking with multiple guys. That might be the same kind of broker capital, other broker shops where form a relationship, for whatever reason doesn't work out, maybe with another broker, but try to spend some time with that relationship first.
Joey, anything to add?
Yeah, I'd say not only myself, but other than the 4 partners, we've got a team of 3 guys, Jeff Kindorf, Grant Raymond, and Nash Rawl, who are here tonight, and they do a great job of every CA on the sheet is their responsibility to make the first touch with. And so in terms of that contact, like you said, we all collaborate, we're all on calls every single morning. So if you told one party something, that should be relayed to the balance of the team. The other thing that I'll say is not always, hey, we want this deal. A quick no is just as effective, or I'll say much more effective than a long maybe, and then sorry, we're not going to offer. There's nothing that makes, you know, the balance of the state more angry when we're expecting an offer on offer day, and you say, oh no, we passed, that wasn't interesting to us. So if you can have a good definitive point of saying, here's why this deal did not work for us. Here's a couple of deals that we've looked at that maybe Jacob had out or John had out in secondary markets. That's really effective for us to put that in the back of our mind, thinking about you for the next opportunity as well.
So recent deals have become extremely competitive, especially since the clock turned into 2021. Is there anything you've seen certain buyer groups that are kind of maybe newer have done on a best and final call or through the offer process that maybe made them stand out and get a little bit of attention, and maybe a little bit a new trick or something you've seen out there that you could share?
I wouldn't necessarily call it a trick. I'd just call it aggression. So I'd say don't get mad at any of us if the pricing moves. It's not our fault. We run this process for a reason, the seller, and that's to drive value. And so if we said guidance was 50 million and now we have to be at 52 plus to be invested final, we're not trying to move the goalposts on it. The market is moving very aggressively. And even once we've talked to people and they said, hey, bottom line, you get into investment final call is 52 million. Some people are just saying, hey, there's 53, don't let me lose this deal. So just be prepared for that. And don't be angry if we call you back and say, it hasn't been a bit, please.
Still get this out of that, but
Mike gets mad at me for that one.
So speaking of that, we've seen quite a bit of price movement here recently, say really the last 4 months. My perception of the market, we play at three to four majors in Texas. We will go to San Antonio. It seems like kind of lowest to highest. It seems like Austin now all of a sudden 3.5 cap market. Seems like Dallas will work like a 375. It seems like San Antonio's a 4. I don't know. Houston, what's Houston today? About a 4.
On the C class, a little higher, but
Yeah, like stabilized cap rates, and that's kind of seems like it's generally generally there, and like, I don't know how the hell we got here. It kind of moved, escalated quickly here in the last few months. So speaking of that, any thoughts on, maybe a couple of people talk about it. What's really changed? Like, why have cap rates compressed so hard in the last 12 months, specifically the last 4 or 5 months? What's behind driving this massive cap rate pressure right now?
Get us started here. I still been thinking about the question and asked like 5 questions about, like, what's the worst someone could say. So I hope we will go back to that at some point. No, anyways, I think it's about alternative. What is the alternative out there? Where people are going to put their money? And you look at the greater or the major markets, there still been a lot of instability, what's known as money markets. And you still have this fear with all the money being pumped out of the system, with the inflation going forward, where we're going to be there if I'm liquid. And then on top of that, the coasts, they have had a tough time. They have had a tougher time. I can guarantee you, sitting in California right now, we wouldn't sit here and with no masks on. So reality is, I think a lot of people are seeing the political environment, specifically in Texas and these markets, and the amount of people coming in here that is putting a tremendous amount of pressure on the market. And we're seeing on construction costs now, just to get materials to the sites and stuff. Prices are so high, so now the supply goes down, demand is still there. So all those factors have really kind of taken us to the next level here if we're in Texas.
Joey, what about the capital? What's different today versus 12 months ago, 24 months ago? The same guys that have been here are still here, and then a bunch of new participants. What's going on with that?
Yeah, I'll give one example. We have an institutional client that owns assets across the country, and we had lunch with them not long ago, and they said they had 2 assets in Oakland that have 30 to 40% bad debt right now. And, near the size and the crowd, most of the assets we're working on here that we're so fortunate to be here, between 1 and maybe 3% roughly. I could be speaking out of turn for some pockets. But I think that really sums up just the overall story and the demand drivers of why people have wanted to be in DFW, both happily and function of, I feel like it's accelerated the last couple of years. There's a lot of California capital here. There's a lot of people from the East Coast as well, but it's really materialized that people are saying, no, we're actually moving our office there. We're building out a local team on the ground in Dallas, Fort Worth, or in Austin. And so that to me has been a huge acceleration rather than just every year there's a lot of people moving here, about 100,000 jobs annually. To your question, Mike, in terms of the capital, I mean, the cost of capital has continued to go down with everything that the lender roundtable said earlier, just where interest rates are, and now the bridge lenders can actually play ball where agency lenders can for a short time period. So that's holding pricing at an elevated level. That this is my opinion, but I don't think it goes backwards anytime soon. And we continue to see this momentum throughout the course of 2021. And I won't speak for beyond that, but in the short term, I feel like that acceleration continues.
Paul or John, what about the secondary markets? What's different in the capital base, with the fire approval, et cetera? What's different today than a year or two ago?
Well, I think there's a whole new entrance. It's multifamily weathered COVID extremely well. People that own retail space, shopping centers, office, any other type of real estate sector, commercial, didn't do well last year. So we're talking to new guys that own shopping centers, father-son team out of California, and they'll really go anywhere because they own shopping centers in small cities. So we're showing them stuff in Albuquerque, El Paso, Texas. Now, I think they're pleasantly surprised how good the financing is on multifamily because I feel like on their other assets, they don't have access to Freddie and Fannie Mae debt. And so while they have to learn some of the nuances of multifamily, they have the capital, and they're seeing how much safer these deals are, and they're not afraid to go to smaller markets because they own already some of these self-storage shopping centers in these tertiary markets. So just new multifamily entrance, I think, is changed the most.
Yeah, you do a lot of stuff. What are any comments to that, John?
We're seeing, like maybe 4 or 5 years ago, investors in a secondary tertiary market, maybe were there just because that was all the only market in which they could participate. Maybe an entry-level deal, they could really get some high cap rates, great yields, and smaller deals. Is competition decreased? A lot of stuff happening in primary markets, not just here, but across the country. There has been an education shift, there's been a perception shift, and we're seeing more and more people intentionally deploying in secondary markets from a primary. They're starting to avoid some of the DFW products, or Atlanta, or certainly San Francisco, some of these markets that yields have compressed so dramatically, and we're able to introduce them in the secondary market to something, cap rates may be lower than it used to be, not DFW low. And just because it's a low cap rate day one does not necessarily mean it's low cash flow over the term that you hold in the deal. So a level of sophistication in the investment will come to the secondary market, and it can.
Okay. James, I don't forget, so we're on a mic. I don't want to hog all the questions. I don't know if the audience might have some questions. These are guys out here doing, billions of dollars of transactions here, basically up here. And I don't know if anyone might have any questions or something that might help you guys out.
This is your chance. They're not gonna pick up your phone calls, and it's your chance. Fire away.
Unless you've read the OM.
Unless you've read the OM. That's your email, that's your subject line, read the OM.
Yeah, I guess why we get it, someone not be so shy. What's, so Joe, you mentioned you think the future is up. I think this pricing is gonna go for a while. Do we see anything that's gonna stop this freight train?
Not in the short term. I think everybody's worried about taxes and what happens next year and beyond that, but where else are you gonna put your capital? I think that's a hard question to answer, especially real estate savvy folks, either within the real estate sector, or anything else that's in the alternative space.
You've seen these offers come in on these bigger portfolio deals, and it's all the usual suspects banging it out against each other, and it's crazy people out of left field.
It is, I mean, because both sides of the spectrum, institutional capital has nowhere to put their money, and the coastal markets, which all these quote unquote sexier markets like Miami, San Francisco, New York, Boston, don't have the inventory to scale. And we've been delivering 20,000 plus units every year. That's all designed to be merchant development. So this is an opportunity I can go pick off 2 to 4 assets in a year in one market. I can't do that in Boston and some of these other places, but yeah, your specific question. Yeah, I mean, it's a lot of the usual suspects, but a lot of new people too.
So Michael, you have purchased over 10,000 doors. A lot of people are concerned about inflation, Biden's tax policies. What's your take? Is it a good time to get into multifamily? Because I know it's an extremely unfair business.
No, I mean, I think it's going up. I mean, I don't see what stops it in the near to medium term with all the structured input costs, people moving here, interest rates are low. I wouldn't take, I'm the guy who's sucked up tens of millions of yield maintenance in my life, so the opposite of you, John. I'm on the team float for life.
Float for life.
Or at least not.
Cap for life. Float for life.
He's not yield maintenance. And I think it keeps going. I don't see what stops it. I mean, we're seeing an insatiable amount, an obscene amount of capital flowing here. I'm beating my head against the wall right now trying to get a deal, and it's extremely frustrating. And I've been disappointed a few times by these two in the not too recent past. So, it's challenging. You see the list of people that are banging it out, and it's all the usual suspects, guys left field. It's a challenging environment. But where are you going to go? Like, where are you going to go? Where are you going to put your money? So I think it's I'm bullish. I'm seeing, and the thing that we're seeing right now that we didn't see last year in real time, seeing 6-8% rent growth in real time. These leases trading out. Half that goes to your bottom line. Half those expensive, half goes to the bottom line. You're in a 3.5 cap market like Austin, or 3.75 cap market like Dallas Fort Worth. Well, I don't like doing math on stage, but that's what it's 25 to value. Dollar NOI is 25 to value, something like that. It's not, you can't make money in this environment. I don't know when you're gonna make money. So
as long as taxes and insurance don't crush you.
But they keep going up. Like, what's gonna stop those? I mean, those are gonna keep going up. It's just a function. But if we're seeing 6-8% rent growth, we're gonna have a year or two of that. I mean, that's gonna materially move these numbers up, and maybe we're in 400,000 units we have in Denver in no time.
What do you guys think about of the line and hit, for the first time buyer, if you were to put yourself in their shoes, what advice would you give them in this market right now?
Well, that goes back to kind of the first question, and I think my statement is the same. I mean, stay on it. And, you know, what we've seen, I think everyone is afraid that we have kind of hit the top developer here. You know, things are just falling apart. But you, Michael, and these other guys' comments, what we're seeing is, like, when you actually go through stats, there's nothing that shows that story. So it's really hard to say, absolutely, you need to be afraid of this. I think everyone is feeling it, but we're seeing it continue to go up. And I looked at settled lease rate, our reports here lately for the first quarter, and you are seeing that 6 to 8% lease rate hours. You know, we don't even underwrite to that on a consistent basis. So it's really, really hard to be sit here and say, oh, you're gonna get hurt tomorrow if you do this. Besides that, it's just stay after it.
Yeah, I think there are markets where it's really good to be putting LOIs out nonstop and getting your name out there, especially for New York. I think this is a market where it's really important to be selective. You know, making sure that you're on the distribution list for everyone on the stage and any other brokers who are in the market. Because as you size up the assets that are available on a weekly basis, you'll know the ones that stick out to you that either on a yield basis or just overall cost basis looks more attractive for your particular equity and your particular situation. So be selective and over communicate to the brokers and other third parties that you're dealing with in your day to day.
Yeah, I would say, you know, provide quick feedback that we talked about earlier. And I'd be really prepared to figure out what you need to do to be able to put up hard money day one. We're not seeing any deals that with a winning buyer is not putting up hard money. So figure out what that means for you as far as the diligence, as far as the tour, as far as confidence in your lender. Figure out what that's going to take for you to put some hard money day one, even if it's a nominal amount relative to the deal side. Just showing the broker and the seller that you can kind of close the deal, even if it's not a significant amount of money. And again, the smaller market, probably less hard money you have to put up, but just figure out where you can compete against, you know, other groups effectively.
Put your team together early, right? Just talk with Old Capital, make sure they understand that they teach you what your capabilities are as an investor. What can you actually target? Get really clear on that, making sure you've got a clear understanding on your lending option, debt option, how you're going to take down a deal. Engaging in the broker community, right? And listening to the coaching we're giving you. And don't get boxed yourself in a corner. Just because I underwrote a deal with this framework last time doesn't mean I have to underwrite every deal exactly the same way. We heard about the different debt options, right? We've got Fannie, we've got Freddie, we've got bridge debt, bank debt. Loan assumptions, might be a really good vehicle. And they might be, but look at the deal at hand and get creative about how that fits with who you are and what your capabilities are. I'm just trying to do the same thing for every single deal.
So tips of the trade, Michael, again, we turn to Michael because he owns more of our unions than anybody else in the room. But Michael, what are some of the things that you should be talking about when you go on a best and final call? What are the things that you should not be talking about when you go on to a best and final call with the seller?
But, I mean, just what these guys said, it's pretty straightforward. It's where's your money, where's your dad, where's your equity, and track record. I don't have a track record, I borrow the track record of my collective team, my management company, my co-partner, you know, your various vendors in there, and just being upfront and honest about the process. And I think at the end of the day, this is a business, it's a real simple business. People do business with people they know, like, and trust. So these guys have to, you know you want to get you access to deals, like you to give you the right, you know, proper guidance to get along the way. And trust that you're going to do what you tell them they're going to do. If you break that trust, it's going to be hard to hold and dig yourself out of. And so, you know, your word's going to be a contract as your bond. And, you know, if I tell them I'm going to do something, I need to do that. And then, you know, being straightforward with them, hey, I'm looking at 2 deals, and you know, I don't know which way I want to go with this. And, you know, maybe I'm 100%, only 50% on your deal. And, And, you know, that's good feedback, that's honest feedback to them. If I go, you know, all the way and I you know, tell the seller on the call that, hey, you know, I'm in your deal, then I have to change and I'm gonna drop this deal because of this other one, I like it better. That's a bad look on you, and that's the way, if you want to do a transaction, that's fine, but you want to be in this business. That's not the way to build your reputation and really, you know, grow up in a business. That's what hopefully a lot of people in the room are trying to do, not just do a transaction, but, you know, get to the business and grow up. And, you know, we're friends with all these guys and, you know, been to town with 3 or 4 of them. Paul, I guess we need to go to town sometime. And that's, you know, build more deals at the corner, some dive bar and North Dallas and probably anywhere and anywhere else. And it's just, it's about the soft skills and getting to know these guys. And, you know, when they had to go fight for you or the next person, you know, that stuff comes in and matters.
So one of the things that you should not do when you're at your best and final is try to beat up the seller in these deals. And what are some of the things that you've heard, Michael, not from your mouth, but from other people's mouths?
I'll let Jacob take it. We had a funny one once, so I'll let you have some names, but we had a deal.
What do you mean, names?
That was you earlier, Paul. So.
I still have to survive tomorrow, so I will stay away from names. But we did have kind of a funny story where we had a best and final interview with a couple of gentlemen, and we also, Mike aside, invited his major investor to sit there. We wanted to make sure he was a part of it, he had good questions, ready to go, and suddenly, out of nowhere, it went personal. And one of the buyers challenged the main investor why he was not saying anything and kept going at it. That did not work out. So I think it's always good to have good questions. They don't always have to be positive. They can be critical about saying, look, these are the things we're dealing with here. This is why we're at this price, because our insurance costs are taxed. That shows that you've done your due diligence, but if you start over in a personal attack just because of it, it's not good.
If the question came on, someone's looking to sell a property, let's say in the next 3 to 6 months, and you go meet with them, any advice for them before they meet with you guys, sort of prep their property? Because we get that question a lot, and most people have no idea. Get ready.
I would say, email Jay 2 minutes. The biggest thing that we've seen is just, there's a lot of property management teams out there who have gotten complacent, that they still think they were in this COVID environment, but there's not real wind growth and everyone's getting concessions and we can't get so-and-so out of their unit. And I would just urge you to, as delicately as you can, because that's the tip of the spear for your investments, be able to push them out over their skis sooner than later, especially right now. I mean, we sit here on May 4th, and this is prime leasing season. You talk about getting the trade outs that the percentages that Jake was mentioning earlier, those are very real. So just as much as you can, don't let your team on site get complacent. And this is the time where those rents show up on the rent roll that you're showing to potential buyers when you're in the market.
I would just add one quick thing. It's okay to come to us for an early period. You might not be sellers today. You might look at selling 6 to 8 months. But if we look at the numbers, if we look at what you're seeing, having that open conversation about how the market is going to react to those numbers, and if you might have some bad debt you want to tackle first, it's evident in the paper, but let's have that conversation. What is your priority? What are you trying to accomplish? What are you going to try to do in the next 6 to 8 months here to get to a number or to a certain situation? So we encourage people, let's start the conversation early, and that doesn't mean you're going to sell tomorrow or we're going to shop the deal, but we're advisors, and we will give you our best opinion back to what direction to go.
Yeah, just expanding on that, right? Engage us early, because we can help turn your speculative value into a real evaluation and understand where it's at in the market today, and what that means to you. Maybe that's not anywhere close to you want where you need to get, and maybe 3 months isn't enough time to reposition, and maybe 6 is enough. Some of the best clients I've ever worked with, we started the first evaluation thinking we're gonna bring in market in, 2-3 months. 18 months later, it's finally positioned where it needs to be, they knock it out of the park. But part of that is like Jacob's saying, we're advisory services, right? We help put a team together. Maybe we lean on a complacent management company. Maybe we identify some CapEx that we haven't seen. Maybe we can reframe some CapEx to hold it off. We don't need to do this yet. Let's focus over here. Engage us early. It's not ever too early to engage us, because we'll start talking real numbers, help you frame what your goals are and how you achieve them.
So, we talk about cap rates, 3.25, 3.5, 4.5, 4.5, right or 5, right or 5.5, 6.
Other way.
Oh, it goes the other way. Let's forget that one. It goes the other way. So what's the reality of pricing per unit in some of these markets? John works in the secondary tertiary markets. What is your pricing for per unit on some of these deals? Paul works in Central Texas and other parts of Louisiana and other parts of New Mexico and other areas like El Paso. Give me an idea of what your pricing per unit is right now. And then I'm going to go over to the choir boys over here and ask them this Class A stuff, what their pricing is. So, John?
Gosh, it's hard to pigeonhole into one price per unit, right? We traded things at $25,000 a door up to $185,000, $190,000.
All right, tell me about what's your favorite market right now that you're seeing a lot of opportunities in for people that want to get into multifamily?
If it's called secondary.
If it's called secondary or tertiary.
There's so many of them. To me, yes, all the secondary markets. You start to see investment metrics, population growth, economic diversity and growth. That's mirrored what's happened in DFW, but sometimes well beyond on a percentage basis what we're seeing in DFW on job creation percentage-wise, population growth on a percentage basis in a lot of these secondary markets. Typical, class C, B. We're anywhere truly in the 55 to 70.
Give me a town, John.
Amarillo, 55 to 70.
Amarillo, Texas. I like that. Paul?
Killeen, Texas, we have the call market is 63 a door. 3 years ago, that was mid-30s a door. Put a client in the off market, low 40s a door, Killeen, but a real bad loan assumption. A client closed on a deal in Little Rock, actually 18 a door. Haven't seen that in some time. We see stuff in OKC, some unique stuff, maybe like low 40s a door still. So those are probably opportunities for some folks. San Antonio have escrows, low 60s a door, but most of the stuff in better parts of San Antonio are going to be much higher than that. That's South San Antonio. Houston, we see stuff, some awkward stuff in the low 60s, but tough demographics. So it varies, but really not much under 50 a door. Even El Paso, we're looking at something that's high 70s a door, but it's a 6+ cap. So very few markets where we see a 6 cap. Like El Paso, Albuquerque. There's a portfolio in Norman that's around that range. So there were very few where you see a 6 cap on.
All right, choir boys. In the A space in the Dallas-Fort Worth, per unit, Class A building, what are we seeing cost? Buy. This is going to shock you right now of where Class A apartments are selling at, trading at right now.
So,
And they're up 30% in the last 12 months.
so Class A new construction, you're looking at garden or wrap products that would be anywhere between, I'm going to give you a wider range, but 220 to 260 per unit, depending on whether it's infill or suburban. You'd be surprised, suburban pricing is actually outstripping town. So we're selling a deal in Knox Henderson for 220 a unit. We just sold a deal in Frisco for 255, and they're the same vintage.
What would that have been last year or the year before?
Last year, that would have been 10 to 15,000 a door shy of that.
So not much of appreciation.
12 months.
Yeah.
And then Class B, wider range, but I'd say 125, and I'll say B, C submarkets around town, In your Planos of the world, that's gonna be plus or minus 160, even pushing 170.
Wow. Jacob?
I don't have much of a different story. I can tell you one here that sold ES at 1986 built, Plano, really good location, 200 a year. So I would say also the range, it all depends on where it is, units on, whatnot. But the vintage stuff, you can call B plus, A minus, you're looking at that from 120, 130, and then going up to 200. And then a lot of the Class A, the new construction, it basically starts there 220. You're seeing a lot of product now. We didn't used to see it, but that 240, 260 mark, that is the new one. And keep pressing.
If we all bring out our cameras and take a picture of these guys up on stage before we say goodnight to them, and put that on social media, so if your friends out in California, make them go crazy when they see that we're at live events. So let's get your cameras out and take some pictures of these folks. All right, a question from my good friend Cornell. We just had lunch with Cornell today.
Yes, you guys have been talking a lot about price. I know what kind of movement in prices have you been seeing from the impact of COVID?
It has gone up. We absolutely, when COVID first hit in March and April of last year, everything stopped. And it was not just a question of pricing and uncertainty, it was literally, we could not execute because we couldn't get out to sites, we couldn't do anything, we couldn't have lender inspections, it was just stopped. Now, this demand kind of bottled up throughout the summer, and then when we ended last summer, or at the end of last summer, it started to really come together. And it went, and we had probably more transactions here than anywhere else from in the second and third and fourth quarter of last year. And we typically have a big event called NMHC conference where everyone's going out, everyone's gearing towards having their deals out. We didn't have that as a corner for this year, so it's a little bit more organically coming into this year, but now we're seeing it in full flow on the buy and the sell side. So it is really, I think, what we are seeing being pressure tested here, being pressure tested everywhere, is that we stand up really well in this part of the world, not only the U.S. but the world, where we're seeing foreign capital coming in, and they're looking at the same numbers as we are. 100, I think, what is it, 150 or 100? About half the American population is vaccinated now. It's far ahead of a lot of places. So there's that much confidence in where we are, and it keeps going.
Is there any additional questions? Again, these are the top guys in Dallas that you want to get to know. So Krista Lee had a question. I'm going to walk over to Krista Lee.
Hello, thanks. So I have a question for you on underwriting and exit cap rates. So typically, types of deals that are kind of our sweet spot, C-class, usually we're a little bit, conservative on the underwriting, holding it for 3 to 5 years. So with the cap rate compression, usually my typical kind of formula on how I determine what my exit cap rate would be is kind of skewing it a little bit, and it makes it a little bit of some gray area about that. So I would love to hear from you on how are you underwriting exit cap rates, and what are you looking at? What levers are you looking at? And are you changing any of that with the cap rate compression right now?
I'd say for us, it's moved a lot. And to Jacob's point earlier about an NMHC, we didn't know if Dallas-Fort Worth was going to get to a 3 cap market. And I would say in the last 4 months, the DFW has moved 25 basis points inside of that. In terms of the exit cap specifically, it depends on the deal, but our 101 model was about 50 basis points over the year one. However, since I've been doing this, exit caps have never expanded the other direction. And so everybody, even on deals that have been deals that have cash flow as well, gotten bailed out by cap rate compression. So right now on Class A assets, exit cap is as low as we've seen as 4. On B and C assets, more 4.5. So it's probably inside 25 basis points to my earlier comment.
Yeah, on C class, we underwrite to 50 basis points higher still. Same for John.
About the same. And I guess really the point is either you want to be a market participant or you don't. Market moves. You know, I mean, at the end of the day, like we can all live in the past and that's the past. And I should have sold all my stuff too early because these numbers these guys are telling me it makes me crazy, but you know, it is what it is. You move on. So the market's moved, and you got to move with it. And I think a 50 bip expansion over year one is probably reasonable. I don't think you get too much pushback from equity.
Is Dallas the new Southern California prices?
Yeah, the new LA.
I want you to think about that for a little bit. So I want to also talk a little bit about assumptions. John was talking about assumptions. These folks over here just completed an assumption of an apartment building, the loan for the apartment building. And, you know, we talked a little bit about how to get into the market. These guys owned 1 or 2 apartment buildings, and then they went from a small number of units to having 180 units. How was the assumption? Did you enjoy that? This is Brett and Tasha Bridwell. Dr. Bridwell is an orthopedist, and this is the brains of the operation over here. She kind of runs the show. How has it been to go through the multifamily business?
We looked at it like everybody else. The market's been hot this past year, and so we took a different look at it and said if we could find something on an assumption basis and save effectively that prepayment penalty that Michael Becker's talking about, he's paid a good bit of, we could ride that out through our whole period and realize that gain on the other end. So we took a different approach. People were not looking at assumptions and decided to target assumptions. And I think we got a good price basis going into the deal. And I think that that's going to really pay off toward the end when we go full circle and realize our full plan for the property. It was still just as much work to do an assumption as a new loan. Thanks to Paul who walked us through it, and thanks to Prince who got it done for us as well.
The reason I bring that up is, again, I think they did a good job with the assumption. Assumptions are good opportunities to find properties. I think they bought that property. If they had bought it with new debt, they would have spent another $3 million more for the yield maintenance penalty that they would have had to pay off by the seller. So that was good that they were able to do the assumption. James?
I was going to ask on distressed deals. Where have you seen them and why? And if any?
Crickets, I guess. I don't know.
I actually got a live one.
A live distressed deal?
A live distressed deal, live data.
Is it a good deal?
No.
I have to ask.
So it's actually already concluded. So this has been a deal, and I'm not going to go into names, but it's a smaller deal that had some issues. Too much capital from the current owner, and they understood that they couldn't fulfill what they need to do. So they just went through a friendly foreclosure at the beginning of the month here. I got the reference points, what the debt was, and it went actually on 4 steps. The 2 first deals, multifamily in Dallas, I've heard of in years. Now, the sad reality is that this deal went, I would say, 20% above where it should have sold from the fact it wasn't on the way. So there you go.
Michael, any stories?
No, there's no distress. Yeah.
Yeah, there's no distress in this market right now.
So I'll give Paul kudos. He sold the deal. I thought Devin would sell the deal of White Sullivan by the Skyline. Yeah, like how the hell that deal gonna sell? Sold it. No shock. He got it. So kudos to Paul.
Tell us a little bit about that one, because that was a challenging one.
I guess aside from all the plumbing issues they had in the buildings, it still garnered multiple offers. and it traded just a little bit above 60 a door. Took a little over 75 days to close, but you know, and John, my partner, to be honest, he was the broker on that, so I wasn't quite as involved. But it had a few little hurdles, but overall it was smooth. It just closed last week.
You guys did a great job on that transaction. It was one of our loans that somebody either had to assume or get a brand new loan from, I think we had done it about three years ago or so. So kudos, thank you for getting us out of that deal. So I think we're gonna end it here. You know, the big thing we want to talk about is really networking. We want you to spend some time, we have some more time here at the location. And then we're gonna go over to the brick house. And we want you to spend some time and invite Jack Blankenberg the beer for his Oasis that he's selling to get you in the list. So what kind of beer do you like, Jack? IPA? His favorite one. So if there's no questions of one right here, we appreciate everybody coming out and spending more time with us. Thank you very much. I'd like to thank all the guys up on stage. Michael Becker, Jacob Anderson, Joey, Paulie Asbeck, thank you for your service, Paulie Asbeck, Officer at Army, thank you very much. And John McGregor, thank you guys, we appreciate it.